Hi everyone. Good morning. Welcome to another investor update from our end. Basically, what we've been trying to do is to uh, do these sessions every month, once in every month. Basically trying to give you updates on how the market is moving, what are the current themes and sectors that are doing well, where what are the possible risks that we are seeing at any point of time. So the idea is to basically cover these topics. Thanks a lot uh, for joining this session over the next 15-20 minutes, and I don't intend to make this a very long detailed presentation, but just 15-20 minutes covering top level ideas, and then we can get into Q&A where we can address your questions one to one, right? So I will move on. I think uh, so quickly, just a recap of our performance. Last 1 year has been very brutal for, Indian markets. We've been one of the most underperforming markets globally, right? And uh, for us, all cases, the two strategies that we run, Techno Funda portfolio as well as the VC investors portfolio, both of them, as we stand today, the 3-year CAGR is upwards of 35%, and for VC investors' portfolio, it's actually upward of 40%. Right now, what I've shown here at the bottom is the 1 year performance, and I've specifically chosen a 1 year period because, like I said, we've been through a very bad, market. Um, we've the I just wanted to highlight how both of our portfolios have done in the last 1 year. As you can see, the last year, 1 year performance, this is the index versus our portfolio. So the index is down four percentage points, four and a half percentage points, whereas we are up 6.5 percentage. So overall, a 10% outperformance versus the index in the last 1 year, as far as the Techno Funda portfolio is concerned. And in the VC investors portfolio, the index again is at 96.66, but we are at 115. So 4 and 15, almost close to 19-20% of outperformance in the last 1 year. Also, please note that we have not seen any drawdown in this portfolio, right? Over the last 1 year. So very successfully, we did see some drawdown in Technofunda, but in fact, VC investors' portfolio was practically flat, no drawdown whatsoever in the last 1 year of correction that we've seen in the markets. Right? I just thought I'll, cover this before we move to the next and the most important discussion. Now, you know, for we just had our, quarterly season, and I just thought I'll summarize how the quarter went by in terms of the earnings growth, right? So both Nifty 50 and Nifty 500. Um, and what I've also done is I've taken a snapshot, and this is a snapshot from from a Kotak report. So it basically covers different sectors and how each of these sectors have done year-on-year performance. As you can see, the large caps have done about 8.7% earnings growth. Mid caps have done double-digit earnings growth of close to 12%, and small caps have actually degrown. So the earnings growth has been negative year-on-year, and accordingly, you have basically seen a lot of correction in the small cap universe. The large caps are mostly in line with the broader economy and the GDP growth rate, but mid caps have been the outperforming, uh, you know, segment, so to say, in the broader markets. And we are out there. There are sub sectors as well. We have EMS, which has done 67% year-on-year earnings growth, followed by, let's say, chemicals, cement. All of these sectors have done very well year-on-year. And like I said, mid caps have outperformed, at least delivered double-digit growth, unlike large caps, which have been more or less close to an average 7 and a 8, 8, 9% earning growth, whereas small caps have actually underperformed. So if you now go back and see last 1 year, what we've done, what we did in June, July, and August, September, till about August, September, we did a lot of profit booking in our small and mid cap positions across the sectors, like across companies where we were very bullish. We've booked profits, and we moved to banks, large cap banks, particularly HDFC and Bajaj Finance. And now again, none of these names that I'm taking are buy sell recommendations. This is what we've already done and dusted. There is no new recommendation here. Uh, right? So, and we moved to gold and silver. Again, gold and silver, not a recommendation. So the idea was to protect our portfolio because we were after a 3.5 year bull run, we were sort of at a point where valuations were very high, and we definitely saw a potential for a good 30-40% correction in the market, which of course panned out over the last 1.5 years, one year, and we've basically protected our portfolio against that drawdown. Now, uh, so from our point of view, this large cap bet, which we took some large cap banks, the large cap space particularly held our portfolio, uh, kept it grounded, kept it protected. But the growth really is in the mid cap space. That's how we are assessing the market right now. Uh, we believe that mid caps and some sectoral mid caps, which where the earnings growth is slightly higher, there the market has much more potential, and the upside, to be honest, is in those niche areas and those specific sectors. The broader markets per se is not expected to uh, create all-time highs, right? So it's going to be range bound. That is our assessment. That is the assessment of how the earnings growth will move over the next couple of years. Now, let's also look at Nifty 500. So what we saw was Nifty 50. Now, Nifty 500, FY26 and FY27 estimate is close to about 10-12%, and this might go up to 15% by FY27, right? Now, if you tie this up with the overall GDP trajectory that we are in right now, and we have seen 4 or 5 quarters of cyclical downturn. We came off really quick from the low base post-COVID, and we saw a good 2-3 year high growth phase in India, after which the base was relatively high, and then we've now for the last 4 or 5 quarters been in a cyclical downturn where the growth rate has come down. Now, one good thing that has happened during this period is inflation is actually come down significantly. So we are looking at 2.5-3% inflation, and so uh, the real growth rate plus the inflation bit, the real growth rate is expected to be close to about somewhere between the 6.5 to 7% range. And if you add inflation to that, we are expected to be in the 10% sort of range as far as our nominal GDP growth is expected to be. And hence, as an economy, we don't expect earnings growth to be significantly higher than the 10% that the GDP is expected to grow at, right? So, so the reality is that for a good 2-3 years, not 2-3 years, but at least for a good 1 to 2 years, at least this year and the next year, we definitely don't expect earnings growth to be significantly high. Like the way it happened in COVID, that is not going to continue for the next 2 years. What we will see is a broader economy growing at large caps maybe settling at higher single digit, and mid caps basically driving the majority of the earnings growth, double digit earnings growth. And it is our endeavor to basically find some of these mid caps, particularly in some of the fast growing sectors, that will essentially, drive our portfolios higher. We don't see a broad-based recovery. We see very specific sectors doing well from here. The average economy per se will grow at just 10%, less than 10%, right? So, and some very few sectors will end up outperforming that. The idea is to basically figure out what are these sectors where we will expect higher earnings growth, and hence position our portfolio as per the growth expectation. Right now, we discussed this last month also, but basically we've just been through a very bad phase post-COVID, post the COVID rally. So in the last 1 year, Sensex is the worst performing market. I mean, no doubt about that. Every other market has done very well. We've had Hong Kong and Shanghai, those markets doing almost 43% returns year on year, uh, which we've taken advantage of through our Hang Seng Bees index, which we've been invested for more than a year now, right? And so we've taken advantage of some of those markets, but our markets per se have been one of the most underperforming markets globally. And it has been the reasons that have led to this 1 year of underperformance have been actually higher valuations coupled with low earnings growth, coupled with slowdown in the overall GDP growth, uh, and simultaneously we had huge FII selling, and to add cherry to that whole thing, we had a 50% tariff from the US, which basically made it worse, right? So it's all been bad news in the last 1 year, and we believe that the markets have discounted all of these factors. Our own, government and RBI have taken a lot of fiscal and monetary measures to make sure that we are recovering out of this as soon as possible, right? So one laudable thing is that both RBI and government have been very proactive. RBI has cut rates, whenever required, and the government has been very proactive, I would say, in, first of all, starting with the tax concessions and the GST rate cuts. All of that have really they've basically done their bit now. And it's now up to the private sector to start significantly expanding capex, which I think will happen slowly over a period of time. But all the fiscal and the monetary measures are in place, except for maybe a few rate cuts, in this year or early next year, right? So we are positioned well. All the negatives have been accounted for. We believe that tactically this is a very good opportunity to deploy more capital, especially in sectors where we believe the earnings growth will be much higher, right? And we will, between the 15 to 20 stocks that we create, and we've said this again and again that we do not believe in over diversifying. If there are five sectors that will do well, we'll just stay invested on those five sectors. We need not have exposure to 15, 20 sectors, unlike other mutual funds, the way they are structured. Now, while all of this was happening, China uh, was starting to do well, right? Last 1 year, we've seen Chinese economy do well, uh, mostly led by, again, some of their tech companies. So the Hang Seng Index has done really well, but what has also done well is the Hang Seng Tech Index, which is up significantly in the last 1 year, right? And the reasons for that being, Chinese, the DeepSeek moment that they had, right? Their tech innovations in AI and, semiconductors and all of that really positions them, very well. Plus, they were already sort of bottoming out in terms of their own valuations. India was at all-time high valuations, while China was like really low, decades of underperformance in the Chinese capital markets. So all of that sort of led to, capital shifting from India to China. And I was basically, so there were some reports that, this is just a, 2 month, 3 month phenomenon, and then capital is going to come back to India, which by the way has not happened. Over the last 1 year, we've seen continuous selling in India, and we've seen continuous buying in China, right? So the idea is that when you have decades of underperformance and then the economy starts to do well, it can't be just a 3 month outperformance, right? It has to be really something big, uh, than just a 3 month outperformance, right? So I think, and this was our view last year, and we continue to maintain that stand that Chinese economy will start to do well. From here onwards, given their, tech advancements, their, supply chain advantage in terms of, the whole semiconductor ecosystem, plus their automobile companies literally, flushing the entire global auto market. and some of these German companies really underperforming there, right? So plus also geopolitically, we see China is much better placed to compete head with US as we stand today. And we believe that in the last 1 year, whatever we've seen in terms of Trump tariffs and how China was able to sort of deal with that situation and I would say emerge as much stronger player has really helped at least build my conviction in the Chinese economy and we will basically continue to hold our trade that we hold right now. On the other hand, what we are also seeing is that US markets have sort of a lot of indicators. You can see this presentation has a couple of indicators which indicate that the US markets have peaked, right? So as we stand today, we are very bearish. Again, not a buy sell recommendation. Please consult your advisor. From our point of view, we believe that US markets will get into a long-term consolidation and correction phase, right? And from an economy point of view, I think they are looking at a stagflation type of situation where inflation will be high, while the growth rates will be really low. And they'll also have this issue with higher unemployment and all of those, right? So the rate cuts will happen. We've already seen a 25 basis points rate cut by the Fed, and I think there'll be a couple more before the end of this year, which in my view is good for us because that basically means higher liquidity in the system, and we believe some of that capital at some point of time will start coming back to India. So we will ultimately see some higher allocation by FIIs to emerging markets and within the emerging markets, especially to Indian economy. Right now, you can look at the P ratio, whichever way, the Schiller P, the mean reversion model, or the Buffett indicator, whichever way. Markets definitely look very expensive. And if you think of it, how every new technology basically brought with it some kind of bubble, right? So when internet started, of course, internet is there today also and growing fast. But when internet came, it created this dot-com bubble. A couple of years back, when we had bitcoins and cryptocurrencies, we had a cryptocurrency bubble also, where there were just too many currencies every week or so. We were hearing about a new currency being launched and all of that, which I think uh, for the good of all is now come down to a selective few currencies right now, right? So every new technology starts with a bubble, and then of course the technology grows, but investors to begin with, they start of fantasizing of a very uh, bullish scenarios, which of course do not continue into the future from a valuation point of view. Of course, the growth continues, but some of these things just from a valuation point of view get too expensive. We believe something similar is happening in US markets right now, where the top 10 companies almost comprise 35-36% of the S&P index, and which is why this AI correction, you know, to whatever extent it can happen, and at some point of time it will happen, will basically lead to the S&P sort of correcting significantly in the next, I don't know, 1-2 years, whenever. I've been talking about this for a year now, but I've been wrong since the last 1 year. But somewhere at some point of time, this has to start happening, right? So the view is very bearish. Uh, Now, this is the last slide of my presentation. We'll get into Q&A. So looking at India, China, US, how we are positioned from an earnings point of view, uh, what are the sectors, where we are looking at faster earnings growth? Basically, what we're trying to do right now is basically chase high earnings growth, right? Whichever sector can basically give me a high earnings growth, I would want to be invested in those sectors, even if the valuations are slightly high. And some of these sectors we believe are really sort of breaking out decadal opportunities, something like a uh, power sector, for example, especially you would have seen we've had a couple of power stocks to our portfolio. We believe the national electricity plan, which is goes till started in 2022. was in two phases, 2022 to 2027, and then 2027 to 2032. So it's almost like a 10-year plan where there's a major overhaul, required in the entire electrification, starting from transformers all the way up to distribution, and that includes transmission and distribution companies. So their entire structure has to be like repaired and improved upon, which needs huge capital to be deployed, and that capital is being spent by government PSUs and the government itself. So that money is driving earnings growth in the power segment, which of course we've taken some exposure. We've also taken exposure to EMS sector, electronic manufacturing, which again, quite highly valued, but we believe this can become like a 10x from here. Because today, as the ecosystem is, we are just assembling things right now. And Dixon, for example, very recently got into a JV with a company to manufacture glass in India, the glass that is used in our phones, right? So I think slowly and steadily we're just uh, building the ecosystem, building the supply chain. At some point of time, and I've said this in the last session also, that except for the chips, I think in another 10 years we'll get to a point where 70-80% of the phones, the parts, the components plus the assembly will happen in India, except for the chips, maybe because those chips, it's very difficult for that technology transfer to happen. But I think except for those chips, everything will get manufactured in India and assembled in India, and that's where we have a long, long journey to uh, go from here onwards. With plus hospital sector has been doing well. We've taken one bet here, which is capitalizing on the hospital sector plus some sort of uh, corporate restructuring that is happening in that space. We continue to be bullish on gold, silver. We are not additionally buying gold and silver, but we believe it's a good hedge to whatever is happening in the US right now, and for whatever the dollar depreciation that is happening right now. We believe gold and silver will position us well, especially from a hedging point of view. We've already done, I think, 35-40% returns here in the last 1 year since we've been holding this. But I think even from a hedging point of view, it makes sense to just keep holding it. So we continue to hold them. Banks, of course, we had a very good view. We added HDFC and Bajaj. But what we've now done is basically move to some of these other fast growing, because what's happening is that credit growth is not happening in these. Credit growth is has slowed down, will probably recover, but we are, as we speak, moving into some niche areas within the banking and the NBFC space where credit growth is slightly higher. And I think some microfinance bets after the correction recently became, very from a valuation point of view, became very attractive. So we're looking at housing finance companies, we're looking at microfinance companies. Of course, we are bullish on the entire banking sector, right? So I think that's how we've positioned our portfolio, plus some, chemical bets, especially chemical bets that take exposure to batteries, right? Neogen, for example, again, not a recommendation, but Neogen, we've been very bullish because Neogen is getting into the lithium battery space, which we believe is a huge growth area. But what has happened is that India, especially, has not seen any big uh, battery player come up in India, right? So, as we stand today, majority of the lithium batteries are being imported from outside of India. At some point of time, Amar Raja or Exide has to come up and say, you know what, we will set up our own battery capacity in India, and that's when some of these Indian players will start scaling. So, plus also they had a fire, in their plant. So things have been slightly slow, but there is no doubt that, over the next 5 to 10 years in India, we will end up, doing a lot of battery, at least if not manufacturing. Lithium has to come from outside of India, but even the design bit and the assembly bit and all of that will happen in India, which is where we will need, you know, players like Neogen, and there are a couple of others like Tatva Chintan, some of these other chemical, even Gujarat GFL, for example. They have huge plans in the battery space, right? So we are tracking that space. We will take more positions there as we go along. But there are these, high growth areas where we believe the earnings growth will be much, much higher than the broader chemical sector, right? So that is how we are positioned right now. We are, mostly mid right now, not so much small. Uh, Trying to balance between mid, small, gold, uh, focusing on a selective few sectors that are doing well, not trying to go beyond, especially very bearish on hospitality, real estate, all of these sectors which are cyclical, so to say, and I've already been through a 4 or 5 year uptrend, so we are, bearish on them, so no exposure there whatsoever. So yeah, I think that's how we are positioned right now. That's how we are thinking. From a risk point of view, I think at least the India story has bottomed out. We do, however, see some risks coming out of US. And in the last 15, 20 years, whatever corrections that you've seen in Indian markets have whatever sharp corrections that we've seen in the Indian markets is mostly been a contribution from outside of India, right? Starting with the dot-com bubble, 2008 financial crisis, COVID, which also came outside of India. All of these are, uh, factors not of Indian origin. They are factors of origin outside of India, and we believe that US from that point of view is risky, which is why it's important to have gold, silver in your portfolio to hedge against possible risks. Although we believe that it won't be like a sharp correction, it will be a protracted recession. So although we are bearish on S&P, but it's not like you wake up tomorrow and S&P will fall 30%. It will most likely be a longish type of correction, where S&P will underperform for a good 4 or 5 years from now onwards. That's the view. And with Fed sort of coming in with rate cuts and all, the Fed will try to do its best in order to provide liquidity to the markets, to basically provide some sort of cushion, and hence we don't see anything happening very sharply. It will be a long protracted recession, long protracted correction, and a long period of underperformance, especially from US point of view. We, however, have bottomed out, and we believe things for us, especially, it is a bottom of market. It's broader Nifty 50 and Nifty 500 are not going to move much. So if you have to make at least double-digit returns from here, you have to know which sectors to invest in, and you have to play those cycles accordingly. So with that, I will end this session. End my monologue, and if you have any queries, happy to